Ladies and gentlemen, welcome to the show. Welcome to FinFluential Media. My name is Chase. I am your host with the most. And what a day, what a week, what a year it has been. And we are going to talk about it because the volatility continues. We had a green day and we're going to talk about why and what could come next. We're also going to talk about the S&P 500 and some dangerous signals we're seeing. Should we believe them or should we ignore it? And what should we do with our portfolios? We're going to discuss it all as it pertains to the S&P 500, drawdowns, pullbacks. We're going to look at upside returns in every scenario, 15% pullback, 10% pullback, and then we're going to relate it all to earnings and strategists' expectations. And then we're going to look at some notable news stories, Percent, Apple, and a couple of others. But before we dive in, if you could please go ahead, like this video, subscribe. It really helps small channels like these. I appreciate you guys greatly. Let's dive in. Quickly, a quick market recap. The S&P 500 up 0.8% today. All sectors gaining with the broad market leading. Stuff like financials, right? Insurance, telecom services, consumer cyclicals. They led. However, we saw green even in tech, even in hardware, software, consumer goods, utilities, industrials, energy, food and beverage, retailers were the only sector that was kind of red today. And even then, negligible when you look at the rest of the market. Very solid day. Definitely a day for risk appetite, no doubt about it. And that is coming off the fact that we actually had a death cross. Now, for those of you that don't know, a death cross is when the 50-day moving average falls below the 200-day moving average. We often get this when the S&P 500 or any stock you look at pulls back. And oftentimes it's a terrible omen. You want to be buying dips when the 200-day moving average is underneath the 50-day, and you want to be selling rips in this scenario. At least that is what we're always told. But the data tells us something different, because if you're a long-term investor with a long side bias, what a death cross can do is actually provide opportunity and a signal for you to get long. And in fact, if you actually go ahead and buy the triggering of the death cross, which triggered today, by the way, in the next month, you can actually see negative returns, right? So 1 month later, you can actually see negative returns. However, when you look 1 year later, you tend to see 10% gains with a 72% hit rate. Now, do be aware that 3 months and 6 months, you can see positive outcomes. However, the hit rates are fairly poor. And essentially what you can expect in the first 1 to 6 months is just some like near-term volatility, and then you get some upside 12 months later. So this isn't a signal to get like bearish. It's not a signal to get bullish. It's a signal for you to start deploying capital and wait out the volatility. That's all it really is. Because at the end of the day, the S&P 500 experiences average annual median drawdown of about 10% in the last 40 years. Now, things can get extreme, but that's generally when there's sort of like a structural problem or a cyclical problem. Generally speaking, these event-driven pullbacks, which is what we're seeing right now, tend to be short, sweet, and painless. And at the end of the day, S&P 500 corrections and bear markets happen. They're not fun, but they do happen. And you can see there's been 25 instances since World War II when we've seen a 10 to 20% pullback in the S&P 500. 7 instances where we've seen 20 to 30%, and only 3 instances of a 30 to 40% drawdown. So they're far and few between. And this is why you always want to stay invested and remain structurally bullish, because in every single one of these instances, we've gone ahead and made new all-time highs, maybe excluding this drawdown now, but we actually haven't gone out and made that all-time high just yet. Also, when we have a quarter or a 3-month period where we've seen a loss of about 15% or greater, that is an opportunity to get long. Have a look at these returns. This is insane. When we've had a 3-month period where we fall 15% or more, 52 weeks later, we see a 16% average return, 23% median return, right? 104 weeks later, 2 years later, you get nearly a 32% return or 39% median return. Very bullish stuff when you look at this. So we recently just triggered this. In the last 3 months, we had a 15% pullback. And again, if you have a longer term time horizon, 12, 24 months plus, you should really be taking this opportunity to deploy capital in your 401k, in your public portfolio, in your own private portfolio, because good things come after significant pullbacks. Even when the S&P 500 has had a 10% drop in 2 days, 12 months later, we tend to see very, very bullish returns. 100% hit rates, so 100% of the time we're higher after a 10% drop in 2 days, 32% average return, 22% median return. You always want to buy the fear, guys. And look, with regards to what we're seeing right now, because every time always feels so scary, we're not really seeing major earnings revisions or earnings guidance cuts. In fact, 2 out of 16 S&P 500 companies have withdrawn or not updated their previous annual EPS guidance. In fact, 14 have actually provided or reiterated their full year 2025 guidance. There's been about 20 companies that reported. The remaining just don't issue guidance at all. So we can't really add them to these stats. So I mean, things still looking pretty good, all things considered. And this is why the average analyst or strategist still has their target above the 5,500 area. You can see there is an outlier right here and right here, JP Morgan, BCA research. But other than that, the average analyst is, well in the 6,000 range, and that does provide tangible upside. And most of them probably expecting a rebound by the end of the year. And that's because they're probably looking at stuff like this. Scott Bessent has come out and said that the Treasury has a big toolkit if needed for the bond market. And so pretty much, Bessent coming out and saying, I got your back. If things get crazy, we will step in a very big way. The Fed will step in too. So that eased the market today. So too did Donald Trump giving Apple a lifeline. He granted temporary tariff exemptions on electronics, solar panels, LCD screens, a whole bunch of electronics. This is for, I believe, 30 days or 20 to 30 days while they go ahead and discuss a whole bunch of stuff. He's also looking at tariff exemptions for autos. However, he did reiterate that tariffs are coming and this will all be temporary. Nonetheless, the market likes to hear this type of stuff. And pretty much what the market took from this is that sort of like 145% or 125% or like 20% reciprocal or 20% secondary tariffs. These are the ceiling, and it's only going to come down from here as countries negotiate, as world leaders do their thing. And then finally, guys, we got some very interesting news. Pfizer ends its development of its weight loss drug, danuglipron, because someone who took this drug got major liver failure, I believe. So they scrapped it, they canceled it. That's one less competitor for Novo Nordisk or Eli Lilly. You still have AbbVie and Merck with their drugs in development, but we'll see how it goes. And it really goes to show what Eli Lilly and what Novo Nordisk have done up to now is quite incredible when even Pfizer couldn't get it done themselves. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.